Hi, hope everybody's doing well. Wanted to talk today a little bit about annuities, which is covered in Chapter 14. This is also going to be covered on the next exam. I think it's a topic most of you have already covered in previous financial classes, focusing primarily on retirement income options with annuities as well as IRAs. So hopefully most of this will be review for you. Let me share my screen real quick. Okay. So most American workers typically receive Social Security income. Hopefully they put aside some resources to prepare them for retirement. Many also invest some of their monies that they don't have in a 401k into an annuity, especially right after they choose to retire. Maybe they're not quite eligible for Social Security and they may choose to continue to work part-time. So in addition to annuities, there's also opportunities to invest in IRAs, which those of you that are accounting majors or even finance majors probably have covered that in previous classes, as I mentioned. First of all, let's talk about what an annuity is, if you just as a refresher. So typically it's a periodic payment that's made to you over a fixed period of time. And it's supposed to cover you for the duration of your lifetime. So the best thing about having an annuity is it guarantees a certain amount of income over a period of time, just like a retirement plan would be, where it would provide you with a fixed amount of income. You know what you can count on. It won't be extinguished after a period of time, maybe that you don't run through that money. That the intent of an annuity is to make sure that it lasts for the duration of your lifetime. A person receiving an annuity is called an annuitant, and that's typically their life, and their life expectancy is the duration of the payment. So everything centers around their life expectancy and how long they're intended to live. If they buy it at the age of 50, they're obviously going to need more income and have a lower payment because they will need the payment for a longer period of time in comparison to if they were 75. If you think about it, an annuity is meant to protect you against the risk of living too long. Completely the opposite of a life insurance policy, which typically tries to cover you if you don't live long enough and you haven't built up enough reserves. Either way, both of them are meant to make sure that there's enough income to sustain either yourself, in this case yourself, through the remainder of your living period of life and covering all your requirements, whereas a life insurance policy, assuming you die prematurely, would cover your family and making sure they're taking care of it for a certain period of time, not necessarily forever. The purpose, again, is to make sure that you provide an income that you cannot outlive, which is great protection to have. And annuities are typically, like insurance policies, are pulled together resources for many different participants. And the best part is that obviously with the law of large numbers, some people will die, some people will live in if you spread that risk across multiple parties or pool across multiple groups of individuals, that's likely going to lower the risk for everyone and reduce the cost overall. There's three different sources of annuity payments that come into an annuity and help cover that cost that you will get paid out. First is you're paying in premium. So obviously each month, or maybe you give them one lump sum, you're paying in a premium payment just like you would an insurance policy if you were buying a whole life term policy. You also are earning interest on that account balance. And then also, if let's say that someone dies early and the monies aren't collected, there's the potential for unliquidated principal, meaning they don't have a beneficiary that would collect it. And if they die prematurely, then there won't be the principal paid out early. So talking a little bit more about individual annuities. So this is typically bought by an individual with the sole purpose, again, to provide lifetime income that they cannot outlive. And there's three basic types that are typically sold in the US today, the fixed annuity, variable annuity, and then the equity indexed annuity, which we'll cover more in a moment. So first, let's focus on the fixed annuity. It pays periodic income payments that are guaranteed and fixed. So you know in advance if it's going to be $1,500 a month, you know exactly what that fixed income is. If they earn better than average earnings, there's actually more money, and that goes to the insurance company or the annuity holding company. The downside for the person holding it is that they don't get the benefit of the good market performance, but they get the security of knowing they have a fixed amount. So if the market does worse than was anticipated, they're guaranteed a certain amount of return. We call two different periods. The period when you're building up monies towards retirement, we call that an accumulation period. So you're putting premiums in and it's being credited with interest, and you're earning and growing that cash value or overall value of the account that's in your name. We call that accumulation period. So let's say you open one when you're at age 30, you're going to build it up, and maybe you won't start collecting till age 65 or 70. That's your accumulation period. The other side of it would be the liquidation period. So this is the period when you're actually getting paid funds out. So let's say you start drawing on your annuity at the age of 65 or 70. That's your liquidation period, and that's when you're actually pulling funds out. So up until that, just like you would a retirement savings account, you're going to continue to build equity and value until the point you need it. You're no longer working, you have no other income, and so that's where your monies are coming from. So the best part about a fixed annuity, as I mentioned, is that you have a guaranteed fixed rate of interest, but you also don't go below market conditions. So that guaranteed rate is usually set at a minimum interest rate level. But the current rate, what the current market conditions are, they could actually show, and some fixed annuities actually would allow you to continue to earn up to that current amount, but you definitely have a floor. We call that a floor that you can't go down below, which makes it really nice. That guaranteed rate usually is somewhere between 1% and 3%, so it's on the lower end. And the current rate might be somewhere around 4%. That current rate typically isn't guaranteed for a long period of time. It might be just for a short period, like 5 to 10 years. And as long as it doesn't seem like a high risk and there's no high risk of having a economic downturn or recession, the annuity company is willing to pay that out. In order to induce people to buy these annuities, a lot of times insurance companies will offer to pay a bonus, and usually they'll help increase the beginning. So they may give you an additional 3% bonus. So if you put in $100,000 annually into this annuity, you're going to earn an additional $3,000 or 3% each year. So that makes it nice. Moving forward, we'll talk a little bit more about the fixed annuity. So fixed annuities can be, the payments can start immediately, or they could be pushed out to a further date. So to give you an example, my mom chose to retire at the age of 65. She put some of her 401k monies and retirement monies in a rollover from her employer, started collecting Social Security, but she wanted to continue to work part-time. So she set it up where she didn't want to take the monies immediately. If she actually could postpone it 5 years until she was at the age where you're required to start withdrawing, which is 70 and a half, she actually was able to build up the value over a 5-year period. And by not touching it, that helped accrue the interest on the account for a longer period. So she had a better payout. So sometimes people want to start paying immediately. Let's say at 65, she didn't want to work part-time. She wanted to start drawing that monies, and she wanted to guarantee it. She could do that, but the payments wouldn't have been as high. But there's an option depending on what your particular personal goals are. So the immediate annuity is the one where you actually get your first payment pretty quickly. You set up your annuity and you start getting a check monthly right away. Another would be, hey, I want to wait 3 years, 5 years until, or could even be 2 years until it builds up a little bit more equity, and then I will get that larger promised lump sum each month. Also, there's something we call a lump sum or single premium deferred annuity out there. And essentially that would be, you get that one big lump sum that you want to be paid out at a certain period of time, that you could invest in a different way. And then if you choose and you want to pay in additional premiums, like I mentioned, you may be required to pay in maybe 10,000 or 50,000, whatever you choose to pay in each year. You could set it up in a flexible premium where maybe you pay in more some years and less in other years, but either way you get an opportunity to put in. There's no penalty for choosing not to put in as much money. So the fixed annuity owner has a choice on how they get their money settled out. Now keep in mind, they're still living. The intent of an annuity is to make sure they have funds in retirement to help fund any of their medical expenses or their care or just living expenses. They can choose to have it paid out in different ways. Most annuities are not annuitized. It's just a statement that they aren't going to be paid out exactly the same way. It really depends on the individual's goals. So under a cash option, this would be, you know what, once I reach a certain age, I would like to just take out a lump sum or maybe get it paid out in 5 installments, whatever I choose, whatever makes sense for me and my personal goals. Another option, which gives a little bit more structured payout, would be a life annuity, where you get a life income is paid to the person whose life it's based on, the annuitant, only while they're alive. So there's no refund. If you die within 3 years, the monies all get turned back over to the insurance company carrying the annuity, which isn't a good thing. But the good part about doing that or choosing that option is if you don't have any dependents, you get a better payout each month, each year by doing that. Another option is, let's say you have a spouse or you have dependents that are relying on that income. You could select the life annuity with guaranteed payments, which pays you that life income, not only while you're alive, but they also promise a certain number of guaranteed payments to your beneficiaries. So obviously, every time you go down the ranking, you're going to get less money. You could pick a 5-year, 10-year, or guaranteed payment, 20-year. As you go down, as you increase the requirements and the promises that are made or guarantees that are made, you're going to get less income each month. But that may be the best option for you and your family and your beneficiaries. An installment refund option pays the life income to the annuitant after the annuitant's death. So if it's not paying it to them after their death. Basically, it pays it to them while they're alive, but then after their death, payments will continue to their beneficiary until the amount that gets paid out equals the purchase price that they set. So let's say they bought one at 100,000 and you live and you get for a couple of years and you get $12,000 a year. Maybe you're only a few years out and you haven't collected that full $100,000 back, the total face value of the annuity. Your family or your beneficiary would get that required refund amount paid out to them. Another would be a cash refund option. It's very similar to the installment refund, but the beneficiary would get a lump sum. It wouldn't be an income amount that should have been paid out to you or would have been paid out in the same method that you had over a period of time. We talked a little about this with life insurance. There's also something called a joint survivor annuity. So you could put that annuity in place that covers both you and your spouse, and it provides benefits based on the lives of both individuals. So one individual dies, it's going to continue to pay the surviving spouse until the end of their life. And then once that's done, then there will be no more income paid out on that annuity. And then sometimes a lot of these don't have, especially like on the fixed income annuity, it's a fixed amount for the next 20, 30 years. We all know that doesn't really take into account inflation. So in order to protect the earning or purchasing power of the annuity that you've bought, you might want to look into an inflation index annuity so that it not only gives you those periodic payments, but they're adjusted for inflation. So they actually keep pace with the market and the value of the dollar. So a variable annuity, essentially what that's going to give you, we just talked about the fix where you want security knowing what you're going to get. But if you want to play the market and you want to get some of the upside value by playing the market, if the market's doing better than the 3 to 4%, you want to get the benefit of those returns, you can choose to do that. The purpose, again, is to provide and give you that inflation hedge. You get to maintain your real purchasing power, and you get to increase your value if the market's up. Now, keep in mind, if the value goes down in the market, you also suffer those losses. No different than if you had a stock portfolio or some other kind of mutual fund investment. You're going to take risks associated with investing in the market. So premiums in this type of an annuity are paid in accumulation units. It's kind of like buying a stock and it has a value, or a mutual fund, it has a value in units. Same thing here. So you're going to pay in accumulation units, and then when you retire, those accumulation units are converted into an annuity unit. So you're buying basically shares or blocks of value in the annuity. So that's essentially how they keep track of it, because each stock may have a different value. Here's an example, like I mentioned, that if you pick different fund options or payout options, you'll notice the settlement will go down each month. So if you want to pick life income with no refund, if I'm going to take the risk that I'm going to get paid as long as I'm alive, but I die prematurely, there's no guarantee none of it will go back to my family, I'm going to get the highest value, highest income amount. And you can go on down through here, but if you go down to a joint and survivor option, which doesn't have which doesn't have a guaranteed number of years, but it does guarantee a refund to your beneficiaries. That's the lowest dollar value that's paid out. Actually, the one before it, the 20 years, the lowest one, but they're close, $1 off. So each option lowers your payment, but it gives you more and more potential payback value for your family. And this one was based on a $250,000 annuity purchase. So a guaranteed death benefit protects the principal against loss due to market decline. So when you have that fixed amount, that guaranteed death benefit really does protect you against the downside of the market. So having that guaranteed death benefit is really good to have. You don't have to worry about losing the value of your annuity. If you buy a $100,000 annuity and the market crashes like it's been doing the last month and a half, you could really lose value in that annuity fairly quickly. So you want to have that guaranteed death benefit left to your beneficiaries. So typically if an annuitant actually dies before they retire and they can't have any opportunity to even use any of it, the amount paid to the beneficiary will be higher, one of two amounts. The first is how much they've actually invested, you have invested so far in the value of the contract, or the value at the time of your death. So they're going to look at, did you spend $100,000 initially, but today it's worth $96,000? They're going to pay the higher of the two, which would be the amount you invested initially, and vice versa. So at the time of your death, if the value is above what you paid, you actually get paid the higher value. So that's good to have, especially in market declines like we're currently going through. So some variable annuities actually pay enhanced death benefits if you choose. So you can actually, but everything comes at a cost. If you choose to say, I want to guarantee and protect the principal, if I put $100,000 in an annuity and the market goes up, I want to make sure that I don't lose, I want to keep my gains, I want to lock in any increases, but I don't want it to ever go below the amount I originally invested. Those are those lock-in investment gains. So you could choose, if like you start at $100,000 and it goes up $10,000 in value, you never want to go below 110,000 now that you've kind of, that's been your new high or market high. You don't want to lose that. That's that stepped up benefit. Of course, to have this flexible and enhanced payout, you're going to have to pay extra fees. So it comes at a cost. It's a nice to have, but it definitely isn't cheap. So you actually are going to be paying for that additional flexibility. And as I just was mentioning, there's a lot of fees associated with variable annuities. First of all, you're paying an investment manager, no different than if you paid a stockbroker or any other investment financial advisor who's going to be doing transactions for you, because you're choosing which stocks you want to invest in for your annuity to get the best returns. There's also an administration charge. That would cover your costs associated with any record keeping and reporting and paperwork that has to be done by the insurance or annuity owner. There's also something called a mortality and expense risk charge. Essentially, these are fees you're paying out associated with your guaranteed death benefit. So if you actually live longer than they anticipated, they're taking on some risk. That will be added to your overall fee. And then if you choose to surrender your annuity before your death, let's say you decide, I just need to liquidate it. We could probably see that happen. Very likely all the people that are being laid off and unemployed currently in the market, they may have invested in an annuity and now they're down on hard times. They may need to surrender that. So there's always an option. You usually get a small percent of what the account value is, which goes down over time, but it's a nice option that you actually get to draw money out of it if needed. And then usually annually, they also charge you a contract fee, something small like $25 to $50 charge annually. But overall, the whole point is that all fees associated with annuities, although it's a great financial retirement benefit plan, it does have a lot of costs associated with it. So if you'd put it in your own savings account, you wouldn't be paying all these extra fees, but then you don't get the upside of guaranteeing your income and guaranteeing rates of return. If you were to look at what's the average, on average 30 to 4% of the total cost of your investment is paid out in fees. So a person, an insurer, your agent that you're working with, your financial advisor that sells you the annuity, they're going to be making 3 to 4%, as well as the overheads that go to their company that are actually putting their name on the paperwork. An equity index, this is the third type. So an equity index really is going to tie your performance on the annuity to the overall growth in the stock market, probably based on an index like S&P 500. And it provides some of that downside protection, like we talked about, against the loss of principal and prior interest earnings, if you choose to go with that. A participation rate essentially means that it's the percentage increase in the stock market index that is credited to your contract. So let's say the stock market goes up 10%. They may not give you the full 10%, but they may give you some percentage of that. So if the growth is 10%, they may give you anywhere from 25 to 75% of that overall growth, but you do get a large percentage of it, so that's good to have. There's also a cap or a maximum rate of return that they put out there. So this is the upper limit of that index on the interest rate earnings that allow you to earn, but at least you get some opportunity to get some of the upside growth. And then there's also a guaranteed minimum value, so it provides that downside protection like we talked about. Went the wrong way, sorry there. Longevity insurance. This is another option. I'm not familiar with very many people that buy that, but it's basically a generic name that's also used in conjunction with a single premium deferred annuity. This is where you do a one lump sum, especially if you're at a more advanced age, closer to the age of 85. Maybe you have a bunch of money that you've come across, maybe out of your other investment funds, and you just want to set up you want to pay one check to the insurance company to get this deferred annuity set up. We call that longevity insurance. Most likely people would set it up because as they're getting in that advanced age, they may need long-term health care or long-term care at a nursing facility. We call that long-term care. It's very expensive. It's anywhere in the neighborhood of $8,000 to $10,000 a month. If you're in a nursing facility for multiple years, it's going to drain your monies. So you want to make sure you have enough money set aside. They could just pay one lump sum out through this longevity insurance to assure that their obligations are covered. There are some low-cost annuities available that don't have a cash value or death benefit with these longevity, but again, and they don't have the ability to access them if you need the funds in emergency. But it definitely helps you as you're getting closer to age 85 and you have other goals in mind about just making sure that you're taking care of the remainder of your life. That may be more important than getting the monies out or getting any payout for your estate. So taxation, why do people choose annuities? A lot of different things would be that you get the tax benefit of using an annuity, especially if you're buying one through a commercial insurance company. If you're buying it through a commercial insurer, we call that a non-qualified annuity, meaning that it doesn't always meet the requirements that would allow it to be deductible from the IRS perspective. There are other types of entities that put annuities out, but they have to meet certain criteria in order to be tax deductible. If it doesn't qualify to meet those income tax benefits where you can deduct on your tax return, the premiums that you pay in are not tax deductible. The investment income you have might be tax deferred, meaning you don't have to pay interest on that, or I should say income tax on that immediately, but you will at some point. That is essentially how it's handled. It's not always the best. So you really want to work with a CPA or a financial advisor to see what the tax implications of choosing this type of annuity would be for yourself. So to give you an example of how it would be calculated, there is a exclusion ratio of what percentage of your annuity would be excluded from taxation. So it's not always 100% taxable and 100% non-taxable. It's probably some percentage of that. First would be you take, what did I spend on the annuity? That's your investment in the contract or the contract annuity. And then the bottom is, how much do I anticipate getting out of that? What kind of payback am I going to get on this annuity over time? And so it can be attractive to buy an annuity if you're making the maximum contributions. To other tax advantage plans, this might be a solution for you. So here's the example. If an individual, let's say he's a male, he's age 65, he purchases an annuity. When I say immediate annuity, he's putting one lump sum paid out to the company he's buying it from at a cost of $108,000. And he wants to be paid out in monthly income installments of $1,000 for the rest of his life. I don't know what his actuarial life expectancy is. I would guess it's somewhere in the neighborhood of 20 to 25 years based on that age. So he could potentially, actually it says below, based on his IRS actuarial table, he has a life expectancy of 20 more years. So expected to live to the age of 85, which is a good long life. So he would get 20 years of being paid out $1,000 a month. So he'd get $12,000 a year times 20 years, that's $240,000. That's his expected return. If he lives his full life, that's how much he can count on getting paid out. Remember, he paid in $108,000 at the very beginning to get that benefit. So he's got the initial investment over the amount that he expects to get returned. So 45% of what he's paid in can be excluded. Basically, then, if he gets, a $12,000 a year payment, 45% of that, or $5,400, would be tax-free, and the remaining part of it would be taxable. So essentially, you're getting tax credit for that, what you've already paid in. But if you earn anything over what you paid in, that would have to be taxed. That's accumulation on your annuity. Wrong way again. Let's jump into IRAs. So an IRA, again, you guys have probably had this. I don't want to dwell on it. This allows workers to have some more taxable compensation, that they can make contributions. They get a tax benefit by paying in. Usually you have till your tax deadline, which this year it's been extended from April 15th to July 15th. But you have till that tax deadline to put money, sock it away in an IRA up to your maximum amount, and you get to deduct that as a tax deduction on your return. Two basic types you guys have probably heard of: the traditional IRA, or just a regular IRA, versus a Roth. The traditional one does allow a worker to take a tax deduction for part or all of their contributions. And when I say part, it's because if they make too much money and there's either AGI or adjusted gross income is higher than the the max of allowable, you might have to pay tax on some more of it, may get phased out. So the investment income that you make on that IRA, if you put in $2,000 in a year or $4,000, that income that's accumulating on it would be tax-free on a deferred basis. When you actually get distributions out of the IRA, those would be taxed just like you would any other ordinary income. You must have earned income during the year, and you have to be under the age of 70 and a half. So those are two requirements. You have to actually be working, and so have earned income. You can't be a retired individual with rental properties or someone who just stays home and takes care of the children. That would not be considered earned income. And if you're past the age of 70, you would no longer be able to use this as an option. You notice it says 2012, but I actually looked up the more current values. So in 2020, the max annual contribution you can put in is $6,000 or 100% of your earned compensation, whatever's less. So if you only work part-time and you only made $4,000, they're not going to allow you to put in more than $4,000 a year. But if you make more than the $6,000 max, that's going to be your high end. A full tax deduction would be allowed under those circumstances. If you have put in more than that, you're not going to get a tax deduction for more. If you're an older individual, and unfortunately for me, I hate to say this, but I'm over the age of 50, so older individuals get to contribute an additional $1,000 per year. So they can do an additional $1,000 on top of that $6,000, up to $7,000 annually without being penalized, or I should say, they'd get tax benefit by deducting up to $7,000. A full IRA tax deduction is gradually phased out, as I mentioned, with their modified age gross income. So if they are a higher income individual, they're eventually not going to have any tax benefit of that full IRA. That does not mean they can't put money in an IRA. It just means that they don't get the same tax benefit. Taxpayers that have that really high income, then I guess it would be phased out. I actually looked at the phase out. So if you are single, you have starting at $65,000 a year, and it gets completely phased out when you're making $75,000 as a single individual. So the income limits are not very high. If you are a married filing joint, as long as you're making less than $124,000, you can get some tax benefit from the IRA deduction. But once you exceed that $124,000 AGI, you'll no longer get any tax benefit. If your spouse, as I mentioned, so maybe you're the working individual with the earned income, you may have limitations, but let's say your spouse does not earn income, they stay home, take care of the kids, or they're just a part-time worker, they would be able to, they're not in the paid workforce, let's say, or they have a low income earning potential, maybe they stay home part-time, they may be able to make that fully tax deductible contribution, but you may not based on your earned income. Sorry, I keep going the wrong way, guys. So distributions, this is the key, 59 and a half and 70 and a half. So those are the two ages you want to remember. At 59 and a half, if you're not there to 59 and a half yet, you're most likely going to be penalized from a withdrawal out of your IRA. Once you exceed 59 and a half, no worries, you won't get penalized that extra 10% in tax. However, there are conditions that would allow you to be able to deduct some of it, and those include things such as you become disabled, maybe your beneficiary wouldn't be taxed on it or penalized because you've passed away during the year. Maybe you have higher education expenses and you can demonstrate that you have a very high educational debt. You might be able to take it out for that reason. If you're trying to buy, build, or rebuild a first home, it might allow you to take out up to $100,000. Also, if you have really high medical expenses, there's some limitations there. Or if you're unemployed for more than 12 weeks or 3 months, which again, we're in a very significant financial crisis right now. So that might cover some people that they could actually start withdrawing out money without being penalized. out of their IRA for that extra 10%. So when eligible distributions start, they're typically treated as ordinary income. Any non-deductible contributions that you made in the past would be received. So if you didn't have to pay taxes on when you're putting them in, then you will have to pay them taxes coming out. But if you had to pay taxes when you put it in because it wasn't deductible, you would get that income tax free. There is a formula out there to help you compute the taxable and non-taxable portions, just like we did with the annuity a minute ago. And it says here on the slide, 2009, the required minimum distribution rules were temporarily waived. That most likely was right after the last economic crisis we had in 2007 and 8. I would be really surprised if in 2020 we don't have that same waiver occur again. But right now, if it were to happen before that gets enacted, there is a required minimum distribution that would have to be taken each year. So typically an IRA is established at a bank or some other, brokerage firm or insurer. It can be set up as either an individual retirement account or it can be set up as an annuity, either way. Again, you can take your IRA money and have those invested in a variety of different options, stock purchases, mutual funds. You get to choose. If you choose to roll over, let's say you have monies that you've been putting in an IRA or you have a retirement fund that you've been putting back a lot of monies. If you retire or leave a company, you have that benefit to roll it over into a IRA and save yourself. If you have that 401k that you had to withdraw when you left the company, they're going to let you put an IRA tax-free if you choose not to cash it out. If you cash it out and you're under the age of 59 and a half, again, you're going to be penalized. So you have to be careful about that. A Roth IRA, you've probably heard of, a little bit of additional tax benefits, but again, you have to watch it carefully because it may or may not fit your specific circumstances. The annual contribution that you can put in a Roth is not tax deductible, whereas we just talked about an IRA might be, but you do get some other tax benefits. So the investment income definitely accumulates income tax free, just like with the traditional, but you get more qualified distributions that aren't taxable. So you may have more benefit of being able to pull it out when needed without being penalized. Also, you can actually continue to make contributions after the age of 70 and a half, whereas with the traditional IRA, you have to stop at that age. You can't keep putting money away into an IRA. There's also more generous income limits. Remember I mentioned 124,000 is the most you can make under the IRA for a joint family, joint married filing joint, and there's higher income limits allowed to utilize the Roth. Also, you can take your traditional IRA and you can convert it to a Roth IRA if it makes sense and you see that benefit. And unlike the traditional, Roth does not make you start taking the monies out as quickly. You can continue to leave them in your account without being penalized like you would in other ways, in other accounts. So here's a quick summary and comparison, side by side, what's the traditional IRA versus a Roth. The ones that are point out to be different would be, what are your age limits? With a traditional, you have to be under the age of 70 and a half. There's no age limit with a Roth. The other major difference would be it's fully deductible up to your annual contribution. I'm sorry, there, jumped ahead. It's fully deductible up to your annual contribution, but contributions are not deductible on the Roth side. So there is some tax benefit that you don't get with a Roth that you would on a traditional. Another major difference is the taxes on distributions. So when you get a distribution with the IRA, because you might get some tax benefit on the front end, you're going to have to pay taxes on when you get it withdrawn out as ordinary income. On the other side, you didn't get the tax benefit with Roth. You had to pay on the front end, so you get those distributions tax-free. So you get to defer your tax benefit to a future year with a Roth, which might be beneficial depending on your level of income. And the final major one would be the minimum distribution. So after the age of 70 and a half, you have to be taking money out of the traditional IRA. They won't let you leave it in there, but you can continue to leave it in there with a Roth. So what's the adequacy of making sure you have enough money set aside in IRA? A lot of times people might go and, if you don't have a life annuity purchased and you didn't save like you should have, IRA funding is a really quick way for retirees that are facing that chance of, I may not have enough money to support myself the remainder of my life. Um, you can go out there and see, do I have enough IRA funds there? Financial planners generally recommend that the initial withdrawal rate should be limited to, you don't want to take all of them out at once. You want to try to limit it if you want it to sustain you throughout the remainder of your life. You don't want to take more than 4 to 5% depending on your age. And then some of the companies actually do some in-depth regression analysis to find out what are the potential market outcomes, what's the high end, low end, what's the probability, what your refund or your interest earnings will be. It's a very complicated calculation just to kind of help you estimate what you think you can get out of your IRAs to make sure you have enough purchase. And this just shows you a last example where if you chose to take out of your retirement $4,000 a month, based on the amount you would be spending, you're going to run out. You only have a 1% chance of your savings lasting you until the age of 95. However, if you decide to reduce your spending by $968, taking that much less each month, you have a much higher chance, 80% chance of your savings lasting you to the age of 95. And, so it depends. You really got to be looking at how much you want to be taking out. This is true of any financial planning. What would you need to limit your withdrawals to be at so it lasts you longer, to kind of spread out your income and not run out the later years when you really might need it. That's all I have, and I will talk to you soon, and we'll be posting after Easter. You guys will have a couple more lectures to review, and I'm going to be setting up a live Zoom meeting next Tuesday, the 14th, to just check in with everybody, see if you guys have any questions, and just talk about what's coming up with a review session in the future. So talk to you soon.